So the biggest enemy of a company is that it's doing well. Asian Paints, Nerolac, Berger Paints, etc. all were running businesses with 35% ROE. Okay, and then you had one company with a 7% ROE saying, "I'm coming in." So that industry had deployed since inception till 2022 10,000 crores since inception till then, and one company says in 2 years I'll deploy 10,000 crores. We definitely like pharmaceuticals and pharmaceuticals which is outbound. So we got a lot of companies out there. I think portfolio weightage is close to about 15% of our portfolio weightage is out there. We like the valuations around IT and the pessimism that sounds that IT is actually doing it, but we are largely with the large cap ITs out there. Between IT and metals, which is one aluminium business and one steel business, that's a position that we are in. And one industry which has been struggling for a little while is the QSR space. I don't know how this thing will bottom out, but prices of pizzas haven't changed for the last 5 years. I don't know what's going to make it change. And the same thing holds true for every other QSR that is out there. The realization per unit is not really stepping up. But once that steps up, I think you will see a sea change in how you perceive that business to be. And trading at reasonably cheap valuations also. So I think that's some flavor that is there. But our portfolio has got 23 companies, but there's not much to choose from after that. So I've made my career in small and mid caps, so I won't even deny it. So to say that I don't like small caps is the wrong thing to do. But at the same time, I would think if you look at the subset of the smaller and the mid-sized businesses out there, maybe 20% of them at a certain valuation are investable. So valuations are right, business opportunities are right, they are scalable business models, and they will make it out there. The maximum amount of mortality rate always happens in this category. Okay, so from a category standpoint, when you have valuations against you and when you have high mortality risk, you can't come out top. I'll say that you got to be a little more careful as far as the mid-sized companies or the small-sized companies are concerned.
Page Industry is one of your multi-baggers, and you got that at a fair valuation, and then the market valued it at 100x multiple. What was the thinking behind Page Industries, your timing, how you viewed the market valuation eventually?
In hindsight, if I look at my portfolio at that point in time, I had a GlaxoSmithKline Consumer, I had Asian Paints, I had Bata, and I also had Page Industries. So I just happened to be in that sweet spot, okay, where valuations were great. Okay, Asian Paints was at 18 times, Page Industries IPO'd at 15 times, GlaxoSmithKline Pharma was at 12 times. They're impossible to think those valuations today, but that's what it used to be at that point in time. There was Hero MotoCorp that was at a dividend yield of 5%. I think everything is cyclical in nature. Okay, if you look from 2000 to 2008, Hindustan Lever gave you a 1% CAGR. It's a long period of time. During that period of time, Larsen and Toubro actually gave you double digit. It gave you almost a 60% CAGR during the same period of time. What's cyclical and what's structural? So profitability usually comes in when the industry profits grow. I think that's where you need to allocate capital. One of our most successful exports will now be airlines, is seat capacity, not aviation, seat capacity. The last time we were doing the numbers, the only company that comes close to us in terms of employee cost to revenue is Ryanair. Otherwise, we are at about 11-12% of employee cost to sales. Anyone else in the West is 20% plus. So you got a category out there where you probably have a right to win at least for a couple of years. If you look at pharmaceuticals, again, we've driven down costs so much and we've created so much of a supply chain in India. Virtually impossible to replicate something like that in the American markets. No, it's going to be an industry that still struggles. Number one will always be number one. You're not going to displace a company that has established its credentials, franchise, its distribution, etc. You're going to give them a tough time. So when a new participant comes in, it usually cleans up the bottom. And Asian Paints and DLF, okay, you can use it at the same time. DLF came through the entire cycle with a cash positive balance sheet. But look at what happened to other real estate companies that were there. I remember something called Parsavnath, Ansals, TB, put the names out. So same thing with paints. I mean, you look who's on sale today. It's the guy who's last in the entire category. So those are the guys where it's easier to take market share from. When it comes to other asset classes, in an inflationary period, which I think will be for a better part of the decade and further than that, the best place to be in anything which has got hard assets. Okay, and real estate forms a part of that.
Thank you so much for being with us here today. And it's interesting because I was just sort of gauging from the audience what the outlook has been since the headlines have dominated with trade tariffs, what they're looking to get out of here. Some people were frank and said we just want stocks and sectors to invest in. But let's get a little bit deeper because we can't ignore the headlines, Kenneth. The fact that we have seen the Trump tariffs, which have been really taking over the headlines. And, you've had investors like Mark Mobius who have actually cashed out 80% of their holdings over these trade war concerns. But your opinion seems to differ. So, why do you think that headlines like this shouldn't be given too much weight? Can you elaborate?
Thanks for being here on this Saturday. Thanks for the invite. Okay. Now, I mean, one look at the audience, and I'm sure you guys have been investing for a very, very long time. And during that period, I think we've come across a lot of volatility, a lot of events, and every time the event is completely different. This time it's a trade war. Of course, there's a reset to how the world actually works. 2019, we had a pandemic. We haven't seen that for we haven't seen too many pandemics in the last 1 century. So, and we came through that one. Then we had a big reset in taxation that took place. And go back to 2008, you had the global financial crisis, then you had the dot-com boom and so on and so forth. And every time the market, every time you saw actually all of this happen, equities actually came back, or asset classes actually came back. Asset classes, whether it's real estate, equities, or everything else, always forms a part of people's portfolio, and that comes back. Now, the fundamentals of all of this, I like to imagine, is that what drives asset classes higher is the simple fact that there's inflation, there's underlying inflation. As long as there's underlying inflation, the underlying asset will always reflect that over long-term periods. And when the asset reflects that over long-term periods, earnings will also follow suit. So I think we'll go through this. We'll navigate through this problem, whether it is 1 year, 2 years, 4 years. I'm not too sure, but we will navigate through this problem as a global economy. When it comes to India, I think we've got a home bias. You and I have a home bias, and we're maybe 3.5-4% of the world economy. Believe me, nobody looks at us except for our population. We're not on anyone's radar. So we've got nothing to lose. Okay, and we've got everything to gain, because larger economies are going through a format where people are losing global market share. We haven't lost anything even till date. So if you recalibrate all of this, there are sectors, companies, businesses out there that are competent, that have been gaining market share, and at the right side of the so-called trade tariffs. So we'll make it. Not all sectors, but at least a few of them will definitely be out there.
So you're saying that we should just ride it out? This is a speed bump along the way. Should investors pause? Should they reevaluate? Should they continue to remain invested? What should be the strategy? Because, now, Kenneth, these headlines are not a once in a decade headline. Today, geopolitical tensions, moving crude oil prices, it's become on the regular. So what do we do?
So I wouldn't worry too much about events. I just worry about the fact that you've got, if you all look at our individual portfolios, you've got 30% CAGR, so close to that over the last 5 years. Okay, even if I stretch it back to 7 years and take off that bump that you had, which was a pandemic. I think most portfolios are between 15 and 19%. It's time to sit back and enjoy the money that you made first. Okay, and this is a period of time where you'll have to wait and watch, or incubate, whichever way you want to do it, and then come back to the marketplace. Frankly, the biggest risk on the entire marketplace today is the valuations of the Indian equity market. There is very less tolerance to any global volatility. And that essentially is the challenge. So any global volatility and news like this, I think the asset class could get volatile. So you said it right. You need a little bit of patience. You need to think a little more long term, and you will come out on the right side of the right side of the economy, or the right side of the marketplace.
Absolutely. And we have a mixed bag of investors over here. I know you walked in and said that, yes, they've all been investing for a long time, but it's very different strategies. Some are these classic long term investors who have ridden it out, who have had the patience. And some are those who invest in the mid and small caps and, are far more riskier, I think, by risk appetite. But you recently mentioned in an interview, don't buy small and mid caps, but I understand that the Old Bridge Fund has nearly 50% exposure to mid and small caps. Do you think that the markets are going to favor this stock picking approach over a category based investing?
So I've made my career in small and mid caps, so I won't even deny it. So to say that I don't like small caps is the wrong thing to do. Uh, but at the same time, I would think if you look at the subset of the smaller and the mid-sized businesses out there, maybe 20% of them at a certain valuation are investable. Okay, valuations are right, business opportunities are right, they are scalable business models, and they will make it out there. The maximum amount of mortality rate always happens in this category. Okay, so from a category standpoint, when you have valuations against you, and when you have high mortality risk, it's you can't come out top. So I'll say that you got to be a little more careful as far as the mid-sized companies or the small size companies are concerned. And it's an asset class that has done well globally. It's beaten all the indices. So if you I mean, my favorite fund is a fund called the Fidelity Low Stock Equity Fund. They have a fund like that, and it's been around for since the last at least 25, 30, at least 30 years, and it's compounded capital reasonably well. Okay, so there's no such thing in it's a no-go territory, but yes, you got to be careful out there.
Okay, so for the investors who are sitting in this room, what do you think in a market environment like this should be the ideal? Look, they don't have, I mean, not everyone has the time, patience, or even the expertise to really delve into each and every company. So, what should the exposure be to mid and small caps, ideally, according to you?
So look at market cap exposure. I think markets are 20. Market cap is 20%, small cap about 35%, 30% mid caps, and the rest is all large caps. So if you just follow a market pattern, large caps, mid caps, small caps, that should fall. That should largely be a range where you should be in, and then depending upon your risk appetite, you take a little bit more of one of the three categories.
Okay, fair enough. Let's talk sectors then. And a lot of fund managers, Kenneth, have been very overweight on the banking sector, but you have that very contrarian view. Why is that?
Uh, okay, it's not really a contrarian view. I can say it here also. Banks are nice in terms of valuation. Okay, but when you go down to the banking system, you'll have to go stock picking out there because not all banks are doing well. And we've run this structure since 2018. 2018 is when we saw corporate India having a lot of cash on book. Excuse me. So they didn't need really bank funding, and at a household level, leverage was increasing. Okay, and everyone was getting reasonably leveraged, and we thought that this was where all the risk actually was, because per capita income going wasn't climbing faster than inflation, and at the same time you had household leverage which was going up. So to stay in the same place or to go get higher growth, a lot of these financials or a lot of lending businesses were taking higher risk. Add to that, you had enormous amount of competition. You had the fintechs come in, you had the NBFCs come in, and you had the banks come in, and the banks, and especially the public sector banks, came back into lending. So when you have too much of competitive intensity, there's usually a challenge, and that's essentially our format of investing. We try to avoid places which are getting crowded. Too much of competitive intensity or too much of competition, you cannot price your product, and if you can't price your product, profitability usually slows down or doesn't grow as fast as it has been historically. And I think that's where we came from. And there was a fundamental logic to as to why we haven't allocated towards banks. Today, I can argue it a little differently. Valuations in your favor, but the intensity in competition has reduced, is reducing. So maybe you will see it in the next couple of months that things will change at the Old Bridge portfolio.
Meaning?
I mean, we've got one lending business. We'll probably add a couple of more of that.
A little more exposure
Yeah.
to banks. So you said you're avoiding places that are fairly crowded and that where the competitive intensity is high. What else are you avoiding sector wise?
Uh, So, our historical experience with state-owned companies, not just in India, across the world, has been a little. We've been a little apprehensive about that because they're not probably the best allocators of capital, and that's one segment of the market that we've stayed fairly away from. And the second place is most of the consumer-driven names. And when I say the consumer-driven names, it's consumer-driven names at the bottom end of the catering to the base of the pyramid. Those are names that we are not very confident on because, again, same problem exists. Per capita income's not climbing, consumption is struggling, and most of these companies don't have pricing power. So that's the other place that we're virtually not present.
Okay, fair. While cyclical stocks do have those time corrections and no structural moves in the long run, they do offer great opportunities if you can time that cycle well. So, how are you assessing the turnaround in the cyclical sector?
I think everything is cyclical in nature. Okay, if you look from 2000 to 2008, Hindustan Lever gave you a 1% CAGR. Okay, 2000 to 2008. It's a long period of time. During that period of time, Larsen and Toubro actually gave you double digit, almost 25. No, it gave you almost a 60% CAGR during the same period of time. So what's cyclical and what's structural? So profitability usually comes in when the industry profits grow, and I think that's where you need to you need to allocate capital. So if I go down that path, um, so okay, I'll say this a little differently. India's got a a fairly large metals business. Steel, we must be about the second or the third largest producer of steel globally. Now, if you look at one of India's companies, okay, which wasn't a very well-run company historically, but it's pretty much a decently run business today um, uh, uh, with manufacturing plants across the world. Uh, and if you just extrapolate his current cash flows into 2030, you'll have a steel company whose balance sheet will look better than an FMCG business or better than Hindustan Levers. So it's a cash generation machine. As long as the product doesn't go out of the cycle and as long as the company doesn't do anything stupid, it's a business that will continue to generate enormous amount of cash. So cyclical business also give you that opportunity. Cash flow comes in dramatically, and as long as you are a good allocator of capital, we shouldn't have a we shouldn't. I mean, it becomes structural in nature. Cash generation becomes structural in nature.
I want to delve deeper into FMCG in a bit, but let's talk individual stocks. Page Industry is one of your multi-baggers, and you got that at a fair valuation, and then the market valued it at 100x multiple earnings multiple. Tell us more. What was the thinking behind Page Industries, your timing, how you viewed the market valuation eventually?
Um, okay, that was. I mean, in hindsight, if I look at my portfolio at that point in time, I had a GlaxoSmithKline Consumer, I had Asian Paints, I had Bata, and I also had Page Industries. Okay, so key in this point, and I see a lot of you must be running industry business or coming from the corporate sector. Now, key to any business opportunity on any investing is that a company's profitability will grow only if the industry's profitability is growing. Okay, so if the industry profitability is constrained, okay, or it's not growing, it's very difficult for a company to grow profitability significantly. So I just happened to be in that sweet spot, okay, where valuations were great. Okay, Asian Paints was at 18 times, Page Industries IPO'd at 15 times, GlaxoSmithKline Pharma was at 12 times. They're impossible to think those valuations today, but that's what it used to be at that point in time. Okay, there was Hero MotoCorp that was at a dividend yield of 5%. So that entire business of the entire subset of companies catering to the underlying consumer to the end consumer was all available at reasonably good valuations. And then you had a small cyclical turn that came post the financial crisis. The cyclical turn came in because the governments across the region incentivized a consumption economy. So they cut excise duties, puts more money in the hands of the consumer, and that's when the cycle actually started. You had more hands in the you had more money in the hands of the consumer, and and the leverage of that income happened. So what you had with Page Industries have it with all the consumer names. And while these consumer names were doing well, any business that was catering to leveraging the consumer cycle, Bajaj, the HDFC banks, and the likes of them, both of them participated together. So when you had expansion of the consumer economy, the liability side did well, and the asset side did well. And that's why Page Industries came out to be 100x. Okay. You also had the automotive businesses do extremely well. So that's where you come from, trying to allocate capital to an industry. That's where you look for category changes or leadership changes in the marketplace, and that's where you get your in inverted comma multi-baggers. You don't go looking for them; you won't find them. They just happen to be there, and as long as you ride the cycle out, it happens. Okay, we've got a slightly different take to the environment at this point in time. So if you've seen most of my presentations and my conversations like these in media, I think we think India with about 3.5% or 4% of world GDP currently. Okay, we are at that sweet spot where we'll create companies and industries that will go global and continue to get market share and dominate market share. Now, this is difficult to imagine given the fact that there's so much of this so much changing on the trade front. But this is also where exactly the opportunity lies. So we created the IT services sector, okay, and this got created because of a problem which was Y2K in the 90s. And this industry also became reasonably large before we had a Ministry of IT and Telecom. Okay, so that's the industry that actually got created at that point in time. So we took our strengths, took it to the global platform, and just dominated that industry. Today, we've evolved to an extent that we can cater to just about any technology that is out there, and you can't take away an Indian IT professional from the global ecosystem. We can do it in a number of other industries. Key to it all is pharmaceuticals. Second, I think chemicals is coming through. We're seeing some part of the entire supply chain getting created in automotive. We've got a very strong automotive supply chain out there. So across the board, a number of these structures are getting created. Now, this is not a 1 year, 2 year, 3 year, 4 year phenomena. This is like a 10 year, 15, 20 year kind of phenomena. But that all of that infrastructure is getting created. So we will do it in the services side for sure, and that's a place that we'll continue to dominate. But some elements of manufacturing will also kick in. I don't I don't see India being a very large manufacturing giant, but there'll be elements of it that will be very successful. Okay, and that's what we think will happen into 2000 into the next couple of years. The foundation of that early entry into the marketplace. This is essentially what we think is happening. So one or two companies from that space will go on to become large. Okay, and reasonably large because
From
most of the
IT services, you're saying?
I think it'll
Ma-
come from pharmaceuticals. You might even
Pharma?
have an automotive company doing well out of this country.
Okay.
Um, okay, we've already got the fifth largest generic agrochemical company out of in the world out of India. So I think that's where we start from. I mean, in steel we're already out there. Um, So just look at look at how that plays out, because let's put it this way: all of these companies that we talk about, right, are addressing now 100% of the global GDP. Okay, you can go to China and get market share. You can go to the US and get market share. You can go to Japan and get market share. So you're addressing a marketplace which is significantly bigger than just the Indian marketplace. And I think that's where I think we'll be starting that journey.
Okay, you touched upon IT services, and I just wanted to understand in a slowing global economy, we're reading these headlines about, you know, massive job cuts. Is that going to affect us here with the advent of AI? What is the outlook on the IT services industry?
You know, I mean, I don't want to go into the outlook of that services. I mean, I'm sure every industry has its challenges. This industry faces challenges, but it's also an opportunity. Any change in the platform, any change in the technology, and a new industry emerges. Right? When horse carts gave way to automotive, the whole automotive supply chain started getting created all over the world. And this is just a structure that will evolve from there. Of course, there will be job losses, there'll be a slowdown, but I think there'll be a whole new ecosystem that gets generated, and someone's got to handle that ecosystem. We will also have to handle that ecosystem, right? You never heard of something called data centers before, and all of that is becoming mainstream. So there are parallels that will get created, and that is where the opportunities shift. You can't stay static. I mean, you can't stay static with your portfolio. You can't stay static with an industry. And as industry evolves, you'll have to find companies that will evolve with that industry. And I think that's what we need to look for, in which company will evolve with changes in what's happening in information technology.
Okay. You had also spoken about how capex is dead globally. What do you mean by this? Are you saying that there needs to be increased exposure or allocation to defensive sectors like your classic FMCG and pharma? Or if you can share in with examples?
So our portfolio, I mean, I've got a very, should I say, I think any business that's catering just to the domestic market, except for a few consumer names which valuations are very good, or even financial names where valuations are very good. I'm not a big proponent of putting money into companies that do not have not established an international franchise. Okay. Now, while saying this, I'm also saying global capex is actually slowing down. So that's a dichotomy, right? But if you hear me out, I've also said the fact that we are just about 3.5% of the world economy, and there's nothing really to bother about. We just have to go out and take someone else's market share. We've got to eat someone else's lunch. Okay, and there's a big market out there. I think that's where you need to think. That's where entrepreneurship has to start thinking about, and that's where you have to go out and deliver those products out there. So let's put it this way: the U.S. is growing the U.S. has got real GDP growth. That means only inflation is growing. Okay, and volumes are coming off. So nothing's happening in that part of the world. China, which is the next largest world economy, is surplus manufacturing. Okay, they've got to find a place to actually sell the product, because internally they can't consume as much as they manufacture. If you look at the European Union, they've got a population problem. They've got an so they're at the peak of their growth levels, unless something else happens to their population out there. So you have a bulk of this entire marketplace that is not growing. This is where I come from and saying that there is a problem that is there in growth globally. So if you step into Europe, there's something funny happening. I mean, they're repurposing all the automotive capacities to manufacture defense equipments. Okay, and the only category that is actually growing across the world is everything that's led to defense. Okay, that's the only category that is going to grow. Now, is that large enough to actually pick through global growth? Mm, I mean, you really wouldn't want that industry to pick up global growth. Then we all genuinely have a problem. So when you look at it, it's an industry which is slow. When you step back and look at Indian companies out there, we really don't have too much of a challenge, because pick our cost. I mean, we still can arbitrage our labor cost in the services economy globally. Um, I mean, one of our most successful exports exports will now be airlines. Okay, airlines is seat capacity, not aviation, seat capacity. That's also because, I mean, the last time we were doing the numbers, the only company that comes close to us in terms of employee cost to revenue is Ryanair. Okay, otherwise we are at about 11-12% of employee cost to sales. Anyone else in the West is 20% plus. So you got a category out there where you probably have a right to win at least for a couple of years. If you look at pharmaceuticals, again, we've driven down costs so much, and we've created so much of a supply chain in India that it's virtually impossible to replicate something like that in the American markets or in US. Those capacities can't come up in the US. You'll have some element of capacities that come in the US, but you can't put up everything out there. So there will be bits and pieces of all of that that'll come through, and that's the battle we need to fight. We shouldn't worry about whether we'll grow or not. That I don't think is a question. Only we will grow. India will be one of the fastest growing economies in the world. Okay, one of my industry colleagues actually said this. You can't bet against India when we're growing at 5%. And you can't be over bullish on India if you're growing at 7%, because 7% will make a mistake and will promptly come back to 5%. But when you're growing at 5%, don't bet against us because we're coming back. Okay. So as long as we maintain this consistency, and this has also got to do with the population that we have, as long as we maintain this consistency, I think we should be pretty much okay as equity investors, as far as fixed income investors are concerned, and everything else.
Okay, given that we should be okay, given that the India story is looking strong, tell us, Kenneth, top three sectors.
So we definitely like pharmaceuticals, and pharmaceuticals which is outbound. So we got a lot of companies out there. I think portfolio weightage is close to about 15% of our portfolio weightage is out there. We like the valuations around IT and the pessimism that sounds that IT is actually doing it, but we are largely with the large cap ITs out there. But again, that the upsides would be capped because these companies are not growth companies. They just mature businesses trading at a certain valuation. To expect a large IT company to grow 10% is I don't think that's ever going to be possible for a while. Okay, so that's our second. I mean, between IT and metals, which is one aluminium business and one steel business, that's a position that we are in. Those two compete with each other in terms of thing. And one industry which has been struggling for a little while is the QSR space. I don't know how this thing will bottom out, but prices of pizzas haven't changed for the last 5 years. I don't know what's going to make it change. Okay, and the same thing holds true for every other QSR that is out there. The realization per unit is not really stepping up, but once that steps up, I think you will see a sea change in how you perceive that business to be. And trading very at reasonably cheap valuations also. So I think that's some flavor that is there, but our portfolio has got 23 companies. There's not much to choose from after that.
So, pharma, IT, metals, and QSR in the long
Not in any particular order.
No, of course, just sharing. I'm just curious to understand your take. There's been so much happening in the IPO market, lots of companies that have been listed. We saw the big bang welcome that they got, and then reality really hit and they had to pull up their socks. What's been your interpretation of all that's happened? Is it don't touch this with a barge pole, or is it looking interesting, select opportunities?
I mean, it's good to know most of these businesses because they usually communicate a lot during their stages of an IPO, and that as an investor, we should all be cognizant of. And then it depends. We are very valuation conscious, and in the IPO market, you do not get anything which is worthwhile. So any issue that is not doing well is usually there. Others we're not. Okay, so that's how I look at it. We're
Wait,
not
so if
very
you're valuation conscious, then I don't think IPOs or the recent
Yeah,
ones would have ever appealed,
not
right?
not
So you think that the markets have given them valuations that are unjustified?
I wouldn't think so because every investor's got a logic to put money into this. It doesn't rhyme with my sense of investing or my terms of investing. So I'm not saying that people are right or people are wrong out here, but yes, valuations being steep, we're not there. But like I said, the entire idea is to make sure that you know each and every of these companies, all the cost structures that are built in. And I'll just give this one example. 2008 or 2007 to 2010, you had spate of IPOs and businesses in the real estate industry. Okay, there was just too much of paper that was coming in. Everyone wanted to be a developer. Everyone wanted to have a land bank. Everyone wanted to understand that business model. It peaked out sometime that time. The next time that index made its all-time high was 2023. Okay. So when industry gets crowded, where too much capacity comes in, it takes almost a decade in some cases for that industry to come back again. And when it comes back, the participants are completely changed. Okay. So one thing that's always required in one thing that you need in investing is one is discipline. Okay, discipline to be there at the right time or to to just not join the party. And the second thing is patience. Okay, and a lot of it.
And I think one of the biggest problems for a retail investor is really judging whether the tailwinds in the company that's doing well is actually going to continue. And how do you judge that? Do you have a sort of a checklist, or what would you say would be the top 3 or the top 5 criteria when investors are looking at companies to invest in?
So one thing, and I mean, it's played out quite beautifully with paints, right? And see what happened to that category itself. So the biggest enemy of a company is that it's doing well. Asian Paints, Nerolac, Berger Paints, etc., all were running businesses with 35% ROE. Okay, and then you had one company with a 7% ROE saying, "I'm coming in." So that industry had deployed since inception till 2022 10,000 crores since inception till then, and one company says in 2 years I'll deploy 10,000 crores. Okay, so the normal structure is every time an industry operates with these characteristics, you will have competition coming in. So it's not just profitability characteristics; it's also market cap characteristics. Okay, so you might not make money and cash flows, but if you have great market capitalization or the market loves you for the business that you're doing, that business is bound to fragment. So one thing that we are very careful about is that we don't like overvaluation in the segment in a sector, and also we do not like all companies in that particular sector making money. If any single company in an industry makes money, we are little wary of it. We don't say we don't go there. We're little wary of it, because if every company makes money, then the industry is going to fragment very rapidly.
Okay, fair enough. So would you say that with other big players entering the paint sector, you'd be worried about market share for Asian paints?
No, it's going to be an industry that still struggles. Number one will always be number one. Okay, so you're not going to displace a company that has established its credentials, its franchise, its distribution, etc. You're going to give them a tough time. So when a new participant comes in, it usually cleans up the bottom. Okay, and Asian Paints and DLF, okay, you can use it at the same time. DLF came through the entire cycle with a cash flow positive balance sheet. But look at what happened to other real estate companies that were there. I remember something called Parsavnath, Ansals, TB, put the names out. So it's same thing with paints. I mean, you look who's on sale today. It's the bottom. It's the guy who's last in the entire category. So those are the guys where it's easier to take market share from.
So, what do you focus on as an investor? Many money managers are chasing that addressable market earnings growth. You seem to be more focused on cash flows and balance sheet. Has that helped you in your investing journey?
Oh, of course. I mean, if you follow the cash flows, that's where the money is, right? So uh, so investing is fairly simple. When we put money to work, we're looking at efficient capital. Okay, efficient capital at a price. Now, if you put both of them together, I think you've got a very you got a very long runaway of the stock doing extremely well. So what we try to do is, like, whenever we buy a business, we try to become the largest investor out there. It usually takes 2 years or 3 years to become the largest investor out there, but when we're there, we just let that business compound.
Okay. And final question from me, and then I have a quick rapid fire also. So, what would you say is going to be the next emerging sector or space that we will see that hockey stick growth for the India opportunity?
It's a while away, but we got one of the largest. We obviously have one of the largest populations in the world, if not the largest. And we're just about 3,500. I mean, we're just about somewhere about $3,000 per capita income. If that hockey stick has to come, it has to come there. Okay, but it's some time away. And when it comes there, it'll come with enormous amount of efficiency, a lot of new segments of the marketplace, and you'll
But are there any emerging themes that you'd look at, say carbon neutrality or biotech or
no,
AI or anything like that?
nothing. Any new theme guzzles a lot of capital.
Guzzles a lot of. Okay.
Okay, we are very wary of that.
Okay.
So if I can get a little technical, we all compute return on capital employed and return on equity, right? So the problem with this ratio is, it's got a numerator which is profitability. It's got a denominator which is capital employed or net worth. When the denominator moves faster than the numerator, okay, when capital employed and net worth moves faster than your earning potential, okay, you don't pay money for that. Okay, and I think that's the problem with any of these new categories that are out there: electric vehicles, artificial intelligence, etc. So I don't think we need to go down that path just now, or we don't go down that path. That
So you're saying the next emerging sector will be one of the traditional ones that have stood this
it's
test
always
of
going
time.
to be traditional, yeah.
Okay. Kenneth, we've got a rapid fire. So this is sort of going to be just, oh, you're dreading this. No, I promise you it's not tough, but just, wanted to get a little bit of a little fun involved as well. What would be the biggest concern for our markets? Would it be tariffs? Would it be China? Would it emerge globally or back some issues back?
Valuations.
Okay. Do you believe in the compounding of a large cap story or an emerging mid or small cap? Which would you tilt toward?
The latter,
Okay.
mid caps.
When you look at the pharma sector, do you think opportunities will likely emerge within large caps or mid caps?
I'm neutral on that. I think it's more or less tilting towards the larger companies, yeah, large caps.
Okay. Do you have one regret that you wish you had, or maybe more than one regret of a sector or a stock that you missed the bus?
Oh no, none, not at all. I can't be at all the happening parties at the same time.
So you're happy being at the
Yeah,
parties that you're at. Okay. Um, do you have a classic mistake that you notice that investors make, and how would you caution them against it?
and I think that last 5 years is not equivalent to the next 5 years. So you can't extrapolate last 5 years and compound it into the next five with any sector, any company, any stock.
Sure, but would there be any one piece of advice that you've got that really sticks with you to date, or maybe a quote that your investment philosophy is based on?
Mm. Yeah, I mean, I work with a gentleman called Vetri Subramaniam in Sherkan and Kotak. I think he gave me, and I was, like I said, I was always in the mid cap and small cap space, picking stocks. He just mentioned that pick a company in a niche and wait till the niche becomes an industry. You got your multi-bagger there.
Okay, there you have it. And maybe top three books that you think investors should read to become or to pick stocks better or to understand market dynamics and investing philosophies better?
I think the three Fidelity fund managers that are there, from Peter Lynch, Anthony Bolton, and Joel Tillinghast. I think these three guys have written three books, and they're the Fidelity fund managers right through almost 3 decades or 4 decades of investing. All of them work together also, so it's a nice compendium of how thought processes got shaped through that fund house.
Okay. Kenneth, thank you for answering those questions and being so candid. I've taken down lots of notes, and I'm sure a lot of you have as well. But like I said, we're now opening it up to the audience. So if you've got any questions for Kenneth, please feel free. We'll have a mic passed on and you can ask.
You mentioned about the fact that last 5 years will CAGR will not repeat for the next 5 years. Taking that into account, Asian Paints or Infosys or HDFC Bank, the valuation or the price last five in 2020, 22 or whatever those period, we haven't reached that highs so far as well. How should you then define your portfolio considering, like you said, kind of create a large cap, mid cap, and small cap? But then if things are not working, then how do you kind of shuffle them across?
I don't think things don't work. Things work. I mean, if you go back, I did mention that levers gave you a 1% return between 2001 to 2008. And then from 2008 to 2020, it gave you a 22% return. Okay, so the cyclicality of it all kicks back. So what didn't work in the last 5 years, maybe the potential of it working for the next 5 years, which is where in the last 5 years, if an HDFC Bank has gone sideways, valuations have corrected because profitability has grown. Okay, and that's where the structure can inverse itself all over again. And in the last 5 years, or till 2018 and 19, if you look at it, most power plants that were there were trading at between 0.5 to 0.75 price to book. Today, all of them are at 6 times and 7 times price to book. Okay, so that's what also happened during that period of time. So the most favored sectors up to 2019, most favored sectors underperformed to 2025. Okay, and now we are looking at probably a leadership change, uh, probably a leadership change for the marketplace at this point, and it's usually led by valuations. So the names that you actually put forward, they might just be some of them might just be right for a cyclical change in where profitability will move now.
So basically, on the cusp of change in terms of.
You, yes, I mean, it's got to be a very extraordinary business to have done well for 5 years and then do continue to do well for the next 5 years. So I don't rule out those companies existing, but they are very extraordinary and they're very few and far between.
General question. According to your experience, etc., we did very well till September last year. Post that, would you say that India is still in a bull market?
Um, I mean, we're definitely not getting into a bear market. We're somewhere between that. So why we're not good? We won't get into a bear market. Is basically corporate India's got too much of cash on their balance sheet. Okay, and we are not at all leveraged. I mean, since we have data since 1999 to 2025, we hit the lowest debt equity ever. Okay, there's too much of equity in the system. The only problem remains is the return on capital employed or return on net equity capital has gotten less efficient. That's about the only change that has happened. So to say that we get into a bear market may not be there, but we're definitely slowing down returns. Okay, so if I can say this, is I'm bullish on equities and bearish on the returns. Okay, so that's the only thing that I can say out there. So within that space, you have to really look reasonably hard enough to get a double-digit return over the next course of the next 3-4 years. But this market can frustrate you because every time it's going to go down, it's not going to fall. It's always going to come back. So it's a cycle that maybe we saw in 2007 to 2013, where again the index was like almost flat. It it whipsawed right through, but the index was completely flat. And I think we're into that cycle. We've seen it before, even in the 90s. Okay, nothing ever happened, but there are some companies that did well, but the rest of the markets just went sideways. So, so, so as a country, we'll be the fastest growing country, if you can call it I call it a bull market. But yeah, equities won't represent that because it's already represented that.
So just to add on to what you just answered, the GDP to market cap is not in comfort zone, right? Even the dividend yield, the P ratios, you did mention, you're picking up Asian Paints page at extraordinary valuations. Then, do you think we will get those valuations back someday? I mean, with 5 years, kind of, you kind of saying, markets kind of economy doing well, but markets not doing well. Would that happen? Do you foresee, or will the valuations continue to remain elevated throughout?
No. I mean, valuation is always correct. I don't think the valuations ever remain elevated in perpetuity. Um, okay. So, so one thing that I mean, we realize is that in the late 90s and even the early 2000s, actually the late 90s, FMCGs were the only place to be in. Okay, apart from technology, they did extremely well during the late 90s. I mean, I remember a company called Gillette being traded at about 200 times earnings, and then after you got it promptly at 30 times earnings after a point in time. So you only have to wait for, you only have the patience to go through that entire cycle. Nestle bottomed out at 35 times, Levers bottomed out at 22 times, 24 times, and Asian Paints at 18 times. Page Industries IPO'd at 15 times, went to 12 times, and GlaxoSmithKline Consumer. And all of these companies were no growth companies during that period. Okay. And over the last 3-4 years, you've seen something very similar happen to all those businesses, right?
Yeah.
Okay. Now, during this process, and this is a process of consolidation, most of these companies come out with go around creating business strategies on how to grow their market share. And one way of growing that market share is, at least historically, is that you go and acquire larger franchises. So if you were there in the 90s, Levers acquired a company called Tata Oil Mills Tomco.
Fonts.
Yes, and they acquired
Lakme.
Lakme. Okay, they acquired all the FMCG businesses of the Tatas. Dabur acquired something called Balsara, etc. And that's how capacities continued to continue to shrink, and companies got larger. So you have to wait for that period of consolidation to happen. It happened at power plants between 2012 to 2020. You had about 25 steel mills that were there. You're down to six basic steel mills in India that do more than 10 million tons of capacity or 5 million tons of production. So this is a process of actually market consolidating. The efficient get larger and more efficient. So, and during that process, I think investors move out and chase something which is moving faster.
Yeah, get it.
Okay. So I think that's how the flow of capital takes place. The flow of capital always chases something that is moving faster, whether it's bankers or whether it's equity investors. We all want something that moves, that's in motion. And anything which is stable, not doing anything, money moves out of it. It's happened with some of the private sector banks. Money's moved out of it. There are question marks around the smaller private sector banks currently. So that's a phase of consolidation that is going through with that system. So yes, you will get them reasonably cheap. I think in the private banking space, you've already got. I think HDFC Bank already is at a number which is slightly lower than his last 10 years average price to book. So you may not get it in the FMCGs just now, but sometime you might get it. But you're already getting it some other part of the marketplace, which is why you can never be bearish with equities, because irrespective of where the markets are, okay, there's always an opportunity that you can pick. When the tech bubble burst, economy stocks did well. When the capex bubble burst, the consumption businesses did well. When consumption is not doing well, again, I mean, the entire capital goods infrastructure businesses continue to do well. So you got to be active in all portfolios. Like, yeah, I said sometime back, everything is structural in nature. There's nothing which is heading just in one direction.
We all kind of agree, right? Inflation is going to be there, throughout, all kind of economies in the globe. How do you play that, right? That is also going to present an opportunity, right? From a sector perspective, or how can one, or rather, which sectors or stocks one should look at, to play that inflation, uh, taking things upward.
I mean, the best part of that trade is probably gone by in the last 4-5 years, right? And that's at a global matrix. In the next year or two, you will see deflationary pressures coming in. And those deflationary pressures are basically because the world's largest manufacturing capacities, which is China, Vietnam, and the Far East part of the world, have no place to sell their products. So they started dumping it all around the region. So anyone in the trade right now, whether it's furniture, textiles, electronics, etc., will get reasonable bargains. How do you get it into the country? I don't know, but you'll get reasonable bargains. So that's something that will happen right now. But after that, there is no such thing as cheap manufacturing anywhere in the world. Okay, so we'll have to wait how these two years emerge. I don't think I can take a structural call as to anyone can take a structural call as how it emerges, because things are reasonably volatile. But but this is a time where everything will consolidate. Inflation will come back. I mean, inflation is there in the US, but there's no way to play it. Only the government benefits and all of that.
Sir, what is your view on other asset classes like real estate, gold, debt?
When it comes to other asset classes, I think in an inflationary period, which I think will be for a better part of the decade and further than that, uh, the best place to be in anything which has got hard assets. Okay, and real estate forms a part of that. Um, Real estate, manufacturing capacities all form part of that hard assets out there. So it's a good place to be. But a lot of that is now. Um, is represented by the equity markets also. So between the two, I think that's a great place to be. Gold can't be an asset class; it can be a hedge, if I might say so. And it can be an hedge against a depreciating currency more than anything else. Okay, so in rupee terms, you made a lot of money in gold. Now you made last year and a half, while there's been a flight to safety, you made money because gold went up as in dollar terms. But it can only be a hedge. I don't think it can be a great asset class, so as to say.
I'm a fairly new investor. I had to ask about how can we plan a safe exit. So a lot of times we get good growth on our portfolio, but since we hope or expect for better growth, but we don't happen to find a time to safely exit from the market. So how can we, or what should be our approach in this regard?
Okay, now I'm trying to think when was the first and last time I exited the market. But no, I think you have to treat investing into equities on a structural basis. Okay, you put money when you have surplus, you take money when you need it, use it as a bank account, and you just have to keep it with a longer time horizon. So anytime you need money in the near term, don't put it in equities, put it in something which is reasonably liquid. But if you're investing over the last 5 years, 10 years, 15 years, 20 years, I think these questions won't be. You after you finished one full round of investing or one full term of investing, you will create enough of pool of capital at a certain percentage of return, where you can always take money out from that pool whenever you need that money. But I don't think you can time this market from the top and the bottom. I don't remember an instance when I've done it in the last 30 years of my investing career.
If India is a growing economy, why are the promoters reducing their stake? We had, I think, Gravitas do that yesterday. And the second question is, we have 1,000 to 1,500 HNIs who are surrendering their passports and seeking citizenship every year.
See, promoters will obviously try to monetize some of their hard work at points in time. Because I'm an entrepreneur and I'm a promoter, so what do I do with all the capital that's sitting in my book and I can't take it out through dividends, because it's the most tax inefficient way of doing it. Okay, so that's probably one point that comes through. So if I have to monetize some of my investments that are there, I will necessarily need to take it away from capital gains, and that's a structure that played out in all democracies anywhere in the world. So it's not very different from here. The second one I think also is happening is that most entrepreneurs think at a certain price that it's a fair valuation to monetize their stake. I think it's more latter, and then it's the former, where it is also a very tax efficient way of taking money out of the market. So those are only two things I can think about as to why promoters are taking money out. Okay, and why are Indians moving to the west? I think the first round of migration, you had the Chinese move all over the world, and then you have the Indians who've now gotten the wealth, who want a better standard of living. So that's obviously something that they're taking a call on. I don't think I have any other other way of explaining that.
I had two questions, two-part question basically. The one was US investing. So recently, I've started kind of putting into US companies in terms of AI because I work in AI field and I see companies like Google, OpenAI, and like OpenAI is not trading, but let's say Google, Amazon, and others kind of making huge investments in terms of data centers, in terms of kind of building that runway for generative AI in the future. Do you think it is a good approach to kind of put some money, like let's say 10% or 20% of my portfolio there, and let it grow and kind of kind of keep it there?
I'm really not qualified to answer US stocks and some of those businesses, but yes, it's a good diversification strategy. You can't put all your eggs into one basket. It's also the world's largest economy, so it works. It works.
Got it. One more question was, so it took a lot of time for me to kind of build a little bit of capital. Now let's say, in future I kind of build a capital up to 50 lakhs or 1 CR. Would it be, it would make sense to kind of do PMS and then just give that capital to someone who is an expert and like yourself or the company which you're running, or similar ones, and kind of take a back seat and let them kind of handle it, because I find it very much like I have to kind of sit 8 hours and earn that money, and then sit 4 hours to protect that money. So does it make sense to kind of give that extra premium and kind of once you get to that capital, let's say right now maybe doesn't make sense, but as you get to that capital, you have banks, RMs calling you for investment strategies and all that. So what is your take on it?
Well, there are mutual funds which are very efficient. So my career revolved from mutual funds, set up a portfolio management product, AIF, etc., etc. But I mean, professional advice, mutual funds are the most convenient, tax efficient model that's out there. And except for one or two alternate structures, I think returns, if you choose the strategy right, is also very much comparable. Right. Well, while saying that, uh, if you like investing in stocks, have the time, have the acumen to do it, go right ahead and do it. Okay, but it does take time. It's an alternate profession. If not, it's a full-time profession, and there is a reason why the money management industry exists, because that is also profession, and that's a full-time occupation for people managing in it. So you got choices of both ends, and you got to decide whether you want it in a professional way. You want professional money managers to manage it, or you can do it by yourself as an individual.
Got it. And in terms of mutual fund, do you kind of prefer like managed or like direct?
Managed or passive, that's an individual choice. There are a lot of strategies out there, there are a lot of passives out there, and there are a lot of industry or sector funds out there. That's a personal choice as to how you want to allocate capital there.
So my question is, which valuation metric should be given more weightage in order to catch up the cyclical trends in any of the industry?
I don't think there's something like that. Okay, but obviously earnings numbers do exist, and I mean, what we follow is any industry which is not doing well, we are very attracted towards it, because somewhere in the course of the next 2, 3, 4 years it will bottom out. So that's our process of actually looking at an industry from a cyclical point of view. Uh, so 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 price earning multiple or price to book is more is something that we like a lot more than price to earnings, uh, for a simple reason. In a cyclical industry, if the industry is not doing well, the earnings is shrinking, so the price earnings will look elevated. Okay, but price to book will give you a better indicator than everything else.
I think with that, Kenneth, we'll wrap it up. You've been very patient and insightful. So thank you so much for being here today and sharing with us your valuable insights. And Kenneth, we would also like to present to you the latest book by Groww, Long and Short. It's these 72 stories to unravel the stock markets. Hope you enjoyed and add it to your list of books that you are reading since you're such an avid reader. Thank you so much for being with us.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.